Welcome to the next edition of Pizz-Spectives. My name is Rob Pizzichetta, founder of Mont Wealth, and I'm very excited today to welcome Michael Armitage from Fund Lab. He's the founder, works with very high net worth individuals and also hedge funds around the world. And in my opinion, one of the smartest minds in economics and finance that I've come across. Welcome, Michael.
Thank you for that introduction, Robert. I'll have to pay you in some way for
Don't need to pay me. You've
some
done,
nice words.
you've done enough to help me already, so I'm happy to pay it back to you. Now, Michael, tell us a little bit about yourself, your background. Clearly you've got a bit of an accent there. So where have you come from and how did you end up in Australia?
I grew up around the New York City area, went to school in the US. Parents are British by background. The first one in my family born in America, so I'm the Yank. Spent some time in school in the UK, went back, as you do. First 20 years of my career was working in New York banks and hedge funds between New York and London, capital markets, global macro, derivative trading. Spent the last 10 years of that in California with a hedge fund, and also for the last 5 years of that working and trying to get my own hedge fund off the ground. When that didn't work out, I moved to Australia in 2010. Really, I came into the country within that gatekeeper community, the research and rating space with S&P. They brought me into the country, and I was in charge of rating the alternative investment category. It was a very good role, got me to understand the lay of the land here, what people, comparative understanding of what was available to wholesale and retail investors. But unfortunately, S&P shut that ratings business down in 2012, 2013, I believe. Off the back of that, consulting just happened. I had groups, whether they were distribution groups, people who were buying managers, calling me up to do reverse DD, looking to buy, and a consultancy was born. Everything from product development teams at some of the banks and asset managers was where I was working. One of those was BT. They were looking at a retirement product probably around 2014, 2015, and they were looking at Milliman. Milliman's a big global risk manager, and they offer services on managing volatility, primarily around pension, retirement age solutions. And one thing led to another, and the head of the business asked me to spearhead the launch of their product development into Australia. And I spent, I think, 6 or 7 years with Milliman. And then I rolled down in Melbourne, and that didn't work out very well. And I just returned back to consulting to people I'm really working with. I see where my consultancy sits at the intersection between asset managers and asset allocators. And so one part of my business might be working with family office or wealth management groups and investment committee or manager research. And then the other side might be with asset management companies in either product development or sourcing very good managers offshore to bring onshore. And that's generally where I work. Probably over the last couple of years, Rob, it's been a lot more dealing with family office and multifamily offices and interacting with a lot of capital advisory groups. So whether that's in private equity or single deal analysis, it's been amazing in terms of just how much has gone on out there and always on that learning curve. That's me in a nutshell.
There you go. We never stop learning, do we, mate? So I want to talk today about 2 white papers that you've published, and you can find those on LinkedIn under Michael's profile. But obviously we'll talk a little bit about what's going on in the US with digital assets, stable coins, whatever you like to call them. But first, before we get there, obviously I need to highlight the general advice disclaimer. Anything from here and after that Michael and I discuss is general advice only. Anyone acting on this advice without seeking financial advice or financial help does so entirely at their own risk. So please seek financial advice because, there's plenty to talk about today. And one of the topics or the most recent publication that Michael's presented on is Mean Reversion, It Remains Undefeated. And that headline itself grabbed my attention, and I went through the paper and had a really good read. Michael, what does it actually mean? What is mean reversion, and why should everyone care about it now?
I stole the headline really from, as a Cornell University professor, David Collum, who is a pretty good writer. I think he does every year a year in review that I recommend everybody to read. Very big picture on a lot of different subjects, whether the political, economic, historical, very entertaining reader. But I think he succinctly put the big picture that everybody in the financial industry over the last year has been thinking about, or over the last couple of years, is extended valuation, particularly around AI and US large cap tech. And the idea is that there's no time in history where stock prices don't mean revert. to the long run averages. So mean reversion is simply, a return to long term averages. Now, the question is, I think over the Case-Shiller kind of Cape history of 100, I think it's 100 years, that average currently might be 17 and a half, but maybe the average that we really should be looking at is maybe from the central banks have been really bastardizing the financial value of money, maybe from 2000, 1998, or pick a date. But over that last 20, 25 years, maybe the multiple has been averaged around 25 or 26 times. And compare that to where we are today, which is around 38 or 39 times. So that idea is, I was always taught, whether it was real estate or whether it was equity markets, the most important thing to understand is the price that you're paying for something. And so at those kind of valuations, we're not getting things cheap. Now, we might go to 50 times multiple. I don't know. That's certainly possible, but there is a risk, right? And I think the idea is that at some point, we will revert to a mean. And so if that's a 26, that's a 30% downside, maybe for the market. I don't think that's very far fetched. It's only 2 standard deviation type of move. And it doesn't mean that I'm anti-AI or I'm anti-digital asset or I'm anti-everything innovation. I think what it means is that we just have to be careful of what our price point is. And maybe don't be greedy. I think is the idea that pigs get slaughtered, right? I think that's in that article as well. I think if you go back to the tech wreck, right, and you look at a company like Oracle, 2001, I think they experienced, I think it was roughly a 70% price fall. And then since then, over the next 20, 24 years, I think it's gone up 24 times. So it doesn't mean that the narrative's wrong. It just means that we'll probably have opportunities to buy these assets at much better prices.
Yep.
And so I think that's the gist of the article. Hopefully that can.
Indeed. Thank you. What are some of the reasons what's caused this excess or optimism?
Oh, look, momentum is a big factor in U.S. equities. I think there's plenty of liquidity. I think a big indicator, maybe going to your questions later, if you look at what's been really driving equity markets has been liquidity. I follow something like the U.S. liquidity index for the U.S. markets, and that's just the amount of capital that's available. And that's looking at the Fed balance sheet, the Treasury, the traded part, TGA, and the repo markets. And they're good places to see where changes in liquidity might occur. And even though liquidity we've had that massive run up since 2020, 21 in terms of off the back of everything, off the back of COVID. And we've only marginally taken that off, and that really started in 22. And since then, it's been flat. So there's plenty of liquidity in the system. I certainly see at the very top end of town, whether it's family offices, multifamily offices, plenty of capital to be deployed. That might not be the same for the guy who's the plumber or the 2 people who are working on salary to try to make ends meet. But there is plenty of capital that is available out there. So, what's driving it at the end of the day? I think there's some fantastic technological advances. AI is going to change the world, and people love a good story, right? So they're going to chase that story. I think the question is, for people like us, we need to try to be a bit more measured and point out where the risk is of going too far on one side of the boat.
Yep. And given you're talking about the amount of liquidity in the system, is this also a function of governments just providing stimulus, but also central banks providing liquidity? And this combination has just kickstarted this momentum trade?
Absolutely. So the amount of capital worldwide that the banks have introduced again off the back of like COVID was massive, was unprecedented. So we're still going to have those ramifications, whether it's just short run transient inflation, or it's really going to be. But the U.S. has certainly been slower to come back on and be providing liquidity. That might change here in September. But other countries have. China has certainly been stimulating, and imagine back to similar GFC type of numbers like the TARP. They're trying to push through to support their banking system, their real estate sectors, as they experience a balance sheet recession. That liquidity shows up somewhere. Needs have their own issues. Everybody is in the same boat. Europeans have certainly been providing more stimulus and liquidity into the system. I don't think that is necessarily bad, and I don't think you can really look at on a month-to-month basis. The way I look at those things is probably like on a rate of change. Where were we a year ago? Where were we 6 months ago? Time frame on that. And if you look at it now, those levels are actually quite elevated in terms of liquidity. That's probably driving the availability for risk assets to continue to go higher my question is, okay, we're already at a high level of liquidity. Do we go higher in liquidity, or is it likely that we're going to start to tailor off on that? And that's when you look at the bond markets and that yield curve, right? There's an appetite, but at what price point does it be deteriorous in terms of interest rates? So I don't think this party has to end at some point. Let's just hope it's not a massive problem and it can just maybe gradually go down.
Yeah. To your point, Michael, someone has to fund these excesses, right? Someone has to provide liquidity to the system, and governments need to borrow capital. So as you noted, we can see that the 20 and the 30-year bond yields are rising versus the shorter end of the curve, which is narrowing because central banks are likely to cut. We've got a combination of rising inflation, but also slowing economic growth. So in effect, it's stagflation. So bond yield are one thing we're keeping an eye on. What are some of the other issues you're watching closely, or some of the indicators that can potentially be a risk to this momentum?
Yeah, so it's those rate of changes, right? Rate of change in employment figures, rate of change in GDP growth, manufacturing, ISM, trade numbers, bank credit, full kind of long-term or long to medium-term global macro indicators, just to get a good sense of, is the economy getting better or is it getting worse?
Yep.
Most of macro factors that I look at, the ones listed, they're getting worse in many parts of the Western world. And China, certainly for us here in Australia, it's probably not as bad as it was, but there still is that balance sheet recession that has to get worked through up there. And you see it in the iron ore price, you see it in commodity prices. Even though we have this inflation, you don't really see those growth commodities doing too well, excepting for gold. And that probably goes back to the original central bank policy of maybe running rates slightly below inflation in order to work off these debt loads, which is probably going to be a generational. And hence you see the price of gold and you see the price of Bitcoin react. That.
Yeah, I know we'll talk about Bitcoin in a sec, but from a portfolio construction perspective, how would you put that all together? And in a strategic, and we'll get the dynamic asset allocation in a sec also, but how would you put that together and to protect capital in this uncertain environment?
Look, I think I have some similar philosophies around this. People that I generally talk to are very, compared to maybe retail investors, they're very more tilted to an absolute return style investment or more capital focused, whether that's in the retirement and pension phase. And so an asset allocation approach that I would look at is a bit more diversified and more diversified for different economic cycles. So it's Bridgewater all weather or even older than that, the permanent portfolio frameworks that people may be familiar with. That'd be the kind of a starting point. So you're allocating for different regimes or different kinds of environment, inflationary regime or recessionary regime, a deflationary and a growth kind of buckets to make it quite simple. There's several groups who have similar philosophies and they tweak that to be a 21st century type of thing. And I would as well, where I would be adding a bit more alternative sources of return in there. And then to your point, you could probably tilt in those depending on where you are in an economic cycle or within a credit cycle. So that goes back to that global macro positioning, maybe not trying to call it on a dime, really trying to understand where you are in the cycle and what's that rate of change towering? Are we getting worse or are we getting better? To maybe try to avoid some mishaps and so if you think of where we are now, a stagflationary type of part in the cycle. So we've had the growth phase, the stagflationary, this growth phase seems to be never ending, especially here in Australia. And I think it has a lot to do with obviously policy, fiscal spending in the US, debt, and then central bank liquidity provisions to extend these bubbles, I don't know if they're bubbles, but these cycles, these asset run-ups. At some point, you have to say, okay, there's a risk that they can't do this anymore. I don't know if that's there or maybe AI will save us, but I think the risks have grown. We haven't had a real reckoning. And so in the meantime, you have to be a bit more defensive. I think from that portfolio construction standpoint, I'm certainly a lot less growth, full stop. But, at this point in the cycle now, it's what growth assets do you hold? Was there a rebalancing away from high tech growth, or can you hold that more efficiently? and maybe into other growth areas that have been unloved. Right. Real estate, global real estate, the list of real estate areas is certainly on a relative basis, probably a more attractive place than maybe your large cap US. Infrastructure, see a lot of interest moving into real assets, assets that are throwing off cash, whether that's in private or public markets. So it's listed infrastructure. And geographically, there's places that you can look at that on a relative basis in terms of cost are more attractive. Emerging markets are starting to become more attractive. China, right? China's the red-headed stepchild out there. We've had people, and we did a lot of review last year on private equity in China. Double up, private equity is unloved, and private equity in China is certainly unloved. So there might be very good opportunities there to be the contrarian. Just trying to be smarter about taking the risk that you're going to take and grow, which you should take. It's just, can you get a better risk-adjusted return at the end of the day?
Perfect sense to me. A lot of those assets you mentioned, we're there and we're doing work on some of the others. Obviously, private equity is one as well. Unfortunately, your capital's tied up for a longer period though. So there's different kind of risks in investing in private equity, but you're definitely doing the work. And yeah, we're also having a meeting this afternoon, Michael, with a global REIT manager. So provide some feedback in the coming days. Now, there's also, I know that you were one of the very first that I spoke to around investing in digital assets. And we can talk about that. But you mentioned earlier that what you do as part of your consulting role is you bring in overseas funds to promote here in Australia or to recommend or do extra work on. And one of them is Apollo. Is that correct?
Yeah, Apollo Digital, they're actually based in Melbourne. So they're not one of the offshore managers.
Okay, there you go. So based here in Melbourne. Now, I know that obviously you're close to those guys and you're very fond of the whole crypto, digital, whatever you want to call it, space. Can you talk us a little bit, what's going on? How did it all start? Where are we now? And where can this asset class get to over time?
Yeah. There's a lot there, Rob.
I know there is a lot. I've already got 10 or so minutes to talk about it.
Look, my first brush with coin initially, when I was working with Milliman, some really smart propeller head actuary guys in there, brilliant guys. Some of them were mining Bitcoin at home. This would be back in, I don't know, 2013, 2014, somewhere back in that time frame. And I read the white paper back then, and it was like one of those, wow, this is pretty profound. And probably the New York cynic in me was like, okay, we're trying to figure out how somebody's going to steal all the money, right? Mm-hmm. My first reaction back in the day. But more practically, I understand probably a little bit better than others how, like, the ability of an asset class to get into real money accounts or into family offices or whatever the pecking order is. The thing that stood out to me back at that time was like, okay, there's no real custody here. It's only if you're a native and you can really take the technological piece and okay, so it's not going to have as much demand. So back in my mind, it was like, this can only take off if the custody solution is solved. There's a vehicle, there's administrators, things that would fit into our world in terms of investment management. Jump forward, maybe 2018, 2019, I was being approached by a couple of different groups who, and they might have been wealth managers, high net wealth managers, and they had somebody who was very interested in the space and they couldn't do something. Can you go and research this for us and talk to my client? And that would be the initial thing. And once you have and the way that I evaluate maybe certain new areas, if I have 2 or 3 really smart people coming to me or people I respect, I've got to spend some time and look at something. Around this same time, I took a trip to the US and there were some conversations there where they were saying, you should be looking at DeFi. And that's like kind of a step beyond where I was with Bitcoin even at the time. And
look at DeFi, is it decentralized finance?
Decentralized finance, yeah, what's going to come down the line. Mm-hmm. And so you start to see this pattern of people who, they call it the brain drain, I guess, from people from Silicon Valley moving over to crypto. So I started to review managers and I started to look at managers. On that trip, I rescheduled my trip home, looking at managers in New York, Chicago, and then the VC guys in San Francisco in the crypto space, just to get an idea of what's available and, who was good, right? Who stood out as something that was interesting. And I looked at all the managers in Australia, and the conversation with the CIO, Henrik at Apollo, was really enlightening. He was very much focused in DeFi, but probably the differentiation for me with them was that they were actually users of protocols. They were developers. So they weren't I would say 90% of the guys I met were guys like me. They were ex-global macro traders. They might have been doing trend. They might have been doing, kind of relative value stuff, but they weren't really the technologist, right? And to understand what's going on there. So that was a differentiation. And they were luckily for me, they were at the point where they needed a bit of institutionalization of what does it look like to be an institutional investment product. And it was very early days. And so I was probably a very good ad for them as that kind of gray hair industry guy. And I started to advise them. And the world was changing pretty rapidly at that time, too, in terms of household name administrators coming on the block, the next generation of custody solutions. And so making sure that they were always at the forefront of those things as the calling card recognition that these guys are really invested well into the business. And then it wasn't hard. Yeah, I don't think I've ever sold a crypto fund. There's always been people who have interest in it and are looking for the best solution.
Yeah.
And then it's just a matter of finding out where are they on that curve. And then you have the world now where it's ETFs. There's a lot of easy access points. And where active managers, somebody like Apollo really fits in. They have a lot of advantages like a good VC fund. Because they've been in the space so long, new developers and that kind of programming or technology kind of background that they have. If I'm starting a protocol, I want to be associated with people who actually know it and they're going to help me develop. So they get access to early deals, but they're also so involved in that segment of the marketplace that they should have better insight in terms of what the next solution out there can add value. So it's a very interesting space. I probably spent the first 9 months, really, it was during COVID, really getting under the hood and learning as much as I could. But I realized that I couldn't do anything else if I was going to stay in that. It's so fast. It's definitely a young person technology space. I still interact with them. They've got a lot of things happening. The world is changing very rapidly. The Genius Act in the US, I think what that does, it just normalizes regulation, which probably enacts a lot of these use cases within that decentralized finance. The way I view it is you have traditional finance, traditional banking, and you had DeFi, digital exchanges, and all the things that were going on. With that regulatory kind of shift in equalization, now TradFi and DeFi can connect. So I think we'll see a lot of proliferation of services on digital rails by traditional businesses, whether they're credit cards, whether they're banks, insurance company, you name it, which I think will just jumpstart and speed up this integration.
So following this announcement, Genius Act, who are the winners and losers post?
Well, I think Ethereum is probably the clear leader, and given the price of Ethereum since the legislation, because of the stablecoin legislation enabling this decentralized financial world, digitalization, if you will, of our finance. And Ethereum is the clear L1 kind of protocol that's people are building on. It just makes that digital asset more valuable. That's a clear winner. And then there's other L1s. I think Hype is one where Apollo has spoken about in their newsletters. That's a digital exchange, a kind of certain features that are very attractive, and the growth has been pretty substantial this year. Yeah, the eventual winners hopefully is all of us, right? A lot of our financial services will become cheaper. I look at it, looking out a couple of years, can we fractionalize? Yeah, private equity, can we fractionalize some other alternative investment funds that becomes easier for us to manage? We don't have to worry about 30-day liquidities or 3-month liquidities in this digital world of fractionalization. Maybe we'll be able to efficiently get in and out of positions better. I can see in superannuation, you can have a super fund that's actually a digital asset. And you've got real-time settlements. You don't have to wait 5 days, 10 days for your money. So all those kind of efficiencies, I think, are at play here across all of the financial industry.
Is Australia ready for that, though, Michael?
Oh, they're going to have to be. It's going to happen.
Yeah.
There's some smart guys coming down here. I've got a meeting with a guy. They've been running a retirement kind of solution online in the US around digital assets, and it's going to come here. It's very simple. So yeah, the world's changing, and that's innovation. It's a good thing.
Yep. And then who are the traditional losers then? I mean, if someone wins, someone's got to lose. Who would you be concerned about that have got old technology or?
Look, I think initially this whole idea of not having intermediaries. So you've got, well, I don't think banks have really been in the business. Back in the day when I worked at banks, our alpha, if you want to call it that, was just information. We sat in the middle, we had the information, and so we could make money off the back of that. That's no longer a case. And so that intermediary rent seeker, if you want, who's sitting in the middle, clipping a ticket on either side, any of those businesses across insurance, across wealth management, across you name it, those things should all become more efficient, ideally, in an ideal world.
Yeah. Now, Michael, this is not advice or a recommendation, but let's just think we're having a beer at a pub and we're talking about what percentage of your portfolio should you have as a stable coin or digital asset as part of your total wealth creation?
Yeah, so I think initially when I talked to people about this, I might have mentioned it a little bit before. How can you get a portfolio to be efficient? A lot of people don't like volatility of Bitcoin or digital assets. I look at it a different way, right? An asymmetric return profile with high volatility. I don't mind that in the portfolio structure. That means I don't have to put a lot of money into it to make a meaningful impact on the portfolio. And that all comes down then what your overall objectives of the portfolio. Maybe for every 1% you put in Bitcoin, you can reduce equity allocation by 5 or 10%, right? If you look at that and if you assume that their growth assets, Ethereum is probably one that's a bit more highly correlated with tech, for example.
Yep.
I look at it as a fintech, liquid VC. That's the way that I look at it. And Ethereum has higher volatility and probably more upside than Bitcoin at this stage. And there's other assets in there that have the same thing, make much more higher volatility. So you can be smart with it. You don't have to be shooting out 10, 20, 30%. I wouldn't recommend that because the volatility would be high for anybody.
Yeah.
But you can make a meaningful impact. And that's just, where are you taking that funding from? In this case, it's tech. It's definitely a growth asset.
Interesting. Now, Michael, again, I'll reiterate that what we discussed today is general advice only. Anyone acting on that advice does so entirely at their own risk. So please seek financial advice. Now, Michael, if anyone wants to learn more about how you might be able to help, whether it's as a consultant role or helping a high net worth individual or even a family office, where do they find you?
Find me through you, Rob, or email Michael, ma@funlab.com.au. LinkedIn's probably the easiest place to just drop me a DM. Those are the places where you'll generally catch me looking at them at least once a week.
Fantastic. I'll put your details in the show notes as well so people can trace you down. Michael, thank you so much for your time today. Very insightful conversation, and looks like I need to do a little bit more work around this DeFi and digital asset space. So thank you very much.
You're welcome, Rob.
Thanks, mate.